looking at the financial markets from a physical systems perspective, I am leaning on Chiara Marletto's book, The Science of Khan and Kant, and I'm asking the following questions. In physics, we have a system of elementary particles and forces that have no design rules. So nothing in the fundamental laws of physics says that systems should end up in Tesla cars, universities, operas, but nevertheless, we get there. And I want to ask the same questions in financial markets. What are the fundamental building blocks of financial markets, and how do we get to the desired state of wealth creation, which is our desired state from a Orange Capital Partners point of view? So this is the topic of this episode. It might feel a little bit of a stretch for now, but I don't think it's such a big stretch because we will get to the point. We will understand that the degrees of freedom, like I discussed many times from this podcast, are very limited. We have a lot of constraints which actually liberate us to pursue our mission. This is the Not Even Wrong podcast. It's June 3rd, 2021. This is Crimdel Code. It's the second episode of today. Since the last update, we are down 3.4%. For the year, we are now down 20.1%. The market is up 11%. We're underperforming by 31%. We took a drawdown in the last hours of the market because of Tesla. There was a news article that Tesla sales in China are cratering. It's not clear what the source is. The market reacted to this very extremely because there is a fear that the bad news about Tesla, which was triggered about a month ago, is affecting the sales of Tesla. And I personally have the following view of this. I think that there is an issue with Tesla as far as customer relationship and perception is concerned. I think China is a wild animal when it comes to that. It is very difficult to deal with public relations issues in China for Western companies because we don't really know how the Chinese feel about things, etc. So I think it is a serious problem. I think this particular article is probably overblown, like many of these things. It could even be shorts that are throwing this out. But on a fundamental basis, I think there is a problem with Tesla and sales in China. The way to overcome this is to keep doing what Tesla is doing, which is delivering the best cars in the world. Also making China less important as a business, which will take a little while. I think we are in for a while now dealing with this drawdown. We have been down 20% 3 times this year. This is the 3rd time. And we expect to have sluggish performance for at least until we see some fundamental real improvements in businesses such as Tesla, of course, and then also our biotech stocks. For example, with Tesla, we expect that the full self-driving suite comes to market, that the subscription comes to market, that the full self-driving beta will get released to the wider audience, and that the results of that will speak for itself. So this would be one, speak for themselves, excuse me. This would be one typical dynamic that we expect to occur. So we have a reversal in this sluggish performance that we're dealing with. We've been dealing with since February. Now let's get to the question. The fundamental question in financial markets is the following. If we look at the components of the financial markets, which is people with money investing in companies and bonds and following certain rules and then ending up in what we call financial markets today. The question is there anything in the rules and the dynamics of the financial markets which gives us confidence that there should be wealth creation in the financial markets? What are the fundamental rules of the financial markets, and then why are the outcomes the way they are? So now let me go back to Chiara Marletto's question, which is she looks at it much more deep. She says we have physics, the elementary particles and elementary forces, no design rules. We have, for some reason, the creation of knowledge, which is information that is able to self-perpetuate itself, particularly in things like physical systems. So for example, we have knowledge how to build a car, and then that knowledge keeps proliferating, and then we have something called an industrial revolution, and we have knowledge how to build a computer and program a computer, and this type of stuff keeps perpetuating itself. and that's why we have progress in the world. And the question now is, well, how did that come across from nothing, from literally nothing? And the answer to that question is, well, it happens because there are certain dynamics in physics, not prohibited by the laws of physics, that lead to that complexity. And that's it. That's more or less what Chiara is saying. Because the laws of physics are not prohibiting it, it happens. So the same way we want to now look at the financial markets and first and foremost ask ourselves, are the laws of physics prohibiting wealth creation in financial markets? I think clearly the answer is no. There's no design rules in the laws of physics, so therefore there's also no particular rule that says you can't make money in financial markets, or more precisely, you can't generate wealth. Now let's look at the fundamental elementary particles of financial markets and sort of the elementary rules. What are they? I think, to cut a long story short, I would say there's only one rule in financial markets that I think is fundamental, and that is the no-arbitrage rule. Arbitrage is kind of similar to free energy, in a sense that if we had arbitrage, if arbitrage would consist for a long time, it would be the equivalent of free energy, meaning energy that is not being used or that is being wasted. And what arbitrage means is that you have a risk-free return that is, after all transaction costs and everything, you still have a return, and that return is for some reason not happening, or people are not taking advantage of it. That would be arbitrage. So I think that is the only rule in financial markets that I think is fundamental. And going from there, we get to this highly complex system that we call financial markets. I spoke in the first episode of today about algo traders and how they are trying to take advantage of mean reversion. They're typically not taking advantage of arbitrage. They're calling it arbitrage, but what they usually do is they take the risk, they take liquidity risk, they take mean reversion risk and things like that. And so it's not real arbitrage. Real arbitrage would literally be if you have no risk, defined as no uncertainty whatsoever, 100% certainty, and you can still make a return. That will be arbitrage, and that is, according to the fundamental laws of the financial markets, now possible. So going from there, we come to a very complex system of algo traders, news, Reddit, all that stuff, the daily, the 24-hour networks, and Bloomberg and whatnot, all these crazy things. And fundamentally, in the end, we get to a point where there's wealth creation. Some people are able to generate wealth, and the question is, how do we get from those fundamental elements, which are again money that is invested in companies by people that have capital, the no arbitrage rule, and then we end up with wealth creation? How does this happen? And what are the fundamental? Are there any fundamental dynamics, laws, or anything like that we can point to that lead towards that? And the answer to that question is there are certain things that we hope at Orange Capital Partners are leading us towards that, and that it would be our principal stack. Our principal stack is a tool that we developed. I wouldn't call it knowledge, because it still remains to be seen if it is knowledge. According to Chiara, knowledge is something that self-perpetuates itself. I don't know if our principal stack in 50, 100 years will still be around. For now, it's working for us. We are still probably doing something like, even with the drawdown that we have of 20% this year, probably about something like 18% CAGR since inception, which is still phenomenal. And therefore, I think we can call it a success. We can call our principal stack a success, and therefore potentially knowledge that will self-perpetuate itself. However, again, we are not sure about it, and I think we need to have a Popperian approach to this, meaning we need to be able to criticize it and find maybe errors and correct those errors. But for now, the principal stack holds. The risks of the principal stack that we're applying is that we miss out on some maybe fundamental rule that we don't have in the principal stack. One of them will be politics. So there's definitely something I've been thinking about recently, which is, look, everything that our principal stack tells us is basically telling us that we have absolutely no reason to fear competition as far as Tesla is concerned. However, of course, if the Biden administration starts tweaking the rules of engagement and the rules and the tax credits and all that stuff towards companies like GM and Ford, I mean, at some point, of course, a company like Tesla will also have a problem with competition. So what I'm trying to say here is that we're neglecting political risk, social risk. Those are risks that our principal stack is not necessarily capturing well. So this would be one criticism that I think under a Popperian lens is certainly fair to assume that that is something that we could potentially be missing out. However, I think that particularly the innovation stack concept of Jim McKelvey takes that into account a little bit, because building an innovation stack requires compounding knowledge and compounding sort of a products and services suite that is such that it will proliferate throughout whatever system you're given. Now, if the system changes dramatically, if you go from capitalism to socialism, then of course it's very difficult to adapt the innovation stack. But we're not there yet, as far as again, as far as society is concerned. So we don't want to ring the alarm bells here. However, again, I just want to point out that to get back to the question, how do we get from the fundamental rules of financial market, which is people investing capital in companies that are in demand of capital, and the no arbitrage rule towards wealth generation? Well, we believe we have a transformatory system, which we call the principal stack. We use discipline, we use consistency, we use technology. Like I said, for example, we read books, we talk to people in academia and science and engineering at the crossroads of science, and where science and engineering are kind of meeting each other. So we try to use technology, we try to use information to get better at adjusting our principal stack, and more importantly, to execute our degree of freedom, which is, like I've said many times, it is really, we only have one degree of freedom. Which company do we invest in? And hopefully, if we're right, we will never have to sell. If we sell, then that is meaning we made a mistake and we get out. We have that degree of freedom, but in a sense, we don't have the degree of freedom, because if we're right, we should never be selling, because it will always be less profitable to sell than to stay invested. So in that sense, we have one degree of freedom, and that is, which company do we invest in? How do we get there? We use our principal stack. We get from the fundamental dynamics and laws of financial markets through the principal stack, which is the transformative knowledge that we apply to get to the conclusion, which is which stock do we invest in, and that should lead us to fulfill our mission, which is to generate wealth by investing in fundamentally new concepts and engineering practices with large impact. Thank you.